right, folks. Thanks for sticking around for the after party. Connie Eddie. Hey, good morning. Thank you all for sticking around for the after party, the vTalk today. We're going to be talking agent finance, bookkeeping, tax management for real estate. And we're so lucky and grateful to have with us today Andrea Rothy with Iris Financial Group. And she did a presentation for us last year. It was fantastic. So I'm excited to see some of this information. Again, this is on Zoom as well. So Zoomlanders out there, if you have any questions, you can put them in the chat and we'll take a look at them at the end of the presentation and have Andrea address some of them. And we are recording this. So if you want to review it later on, it'll be posted to the Village Education website. So it'll be recorded for us. So without any further ado, I'd like to introduce you to Andrea Rothy. Thank you so much.
Hello, how are you guys?
Good.
Well, since this was optional, it sounds like you guys are excited to learn about finance. I'll try to keep it fun and light and not boring because, you know, numbers in finance get very stale. Oh,
they're seeing you there.
Hello. All right, wonderful. Okay, so just a little quick icebreaker. I'm one of the partners at Iris Financial. A little fun fact, I used to fly airplanes when I was younger. I played tennis in Santa Barbara, and I have 2 kiddos, 2 chickens, 2 shepherds, and 1 loving husband. All right, so what I wanted to cover today was some best practices for realtors and finance, managing your finances, important due dates that are all coming up, typical tax deductions that you might want to consider, retirement contribution options, real estate investing, how to set up a new entity, and an intro to QuickBooks. And again, I know this sounds kind of boring, but I'll try to keep it fun and light and answer any questions. Okay, so if I had top 4 best practices, the number one thing that I would suggest, if you could do this, literally if there's any time to do it, today is the day to start. Keep your business and personal expenses and revenue totally separate. So I think what happens a lot of times is realtors, you just get started and a lot of it feeds into your personal bank accounts. So one of the biggest things to do as of today, if you can, go ahead and open up a separate bank account, open up a separate credit card, and keep it 100% separate. It avoids having disorganized and messy books for your CPA, also inaccurate tax returns, or you might not be taking full advantage of all the deductions, and that has an impact on your tax liability, and also missed growth opportunities. So if you're not able to see clean numbers, then you don't know really how you're doing. How many people always tell me, well, my bank account's healthy, but that doesn't really mean much, or that doesn't really say much of how you're doing. Obviously, pay your taxes on time. A lot of you guys probably have to pay estimated quarterlies. And what I typically do, even for myself, I'll put reminders in a calendar and automate it year after year so you don't miss out on that. And then I'm in accounting, I have a CPA do my tax returns. So hire a professional to do them. It's one of the best decisions because every single year the tax laws change and it impacts you in your tax liabilities, and CPAs on an annual basis have to keep up with the tax legislative changes so they can strategically help you save more money. So I would hands down look into hiring a professional to do your tax return. So we talked about keeping personal and business finances separate. As I mentioned, if there's any day to do it, start today or tomorrow. Go ahead and open up that separate bank account and credit card. And start flowing all those business expenses and revenue. And I'll go through what are typical tax deductions. And those are things that you can go ahead and change over to that business bank account. Another helpful little tip is go ahead and open up a savings or emergency bank account. You guys all know real estate is a roller coaster. Sometimes you have really good months, but then you might have some slower months. It's always good to have about a 6-month emergency fund that you guys can have on those slower months. And one little trick that you could do, anytime you get a commission check, automatically take a percentage of that commission check and put it into that savings account. Or if you're like, how much should I save for taxes? If you are keeping up with your books and you're a single member, like a sole operator, you can take 20% of your net income, which is your bottom line, and transition that over to your savings account on a monthly basis. That way you're already saving for taxes throughout the year on a monthly basis. Because what happens at year end, how many people are stuck with abnormally large tax bills if you have a really big real estate year? A lot of people. We've gotten a lot of those phone calls and they're not prepped for it. So if every single month you automatically took out 20% and put it in that savings account, then when it's time to pay your taxes, that money is not in your operating account. You don't see it and you're ready to pay that off right away to the IRS, which is really nice. And it's just being kind of ahead of the proactive as opposed to reactive. And then getting a business credit card is also really smart. You're able to build business credit. Obviously fraud purposes, if there's a transaction that hits your debit card, it's much harder for a bank to return that. It takes a lot longer. With a credit card, they'll do it right away. And then of course, rewards points. If you're already going to incur the expense, you might as well get rewarded for it. So whatever pertains to you, maybe you want cash back. Maybe you like to travel on Southwest, so get a Southwest business credit card. You're already incurring those expenses. Go ahead and take advantage of the extra perks that a credit card is going to give you. And again, this credit card needs to be totally separate than your personal card. Do not intermingle those. Okay. Managing your finances. So we're obviously huge on integrating technology and apps, as are you guys. You probably use it in real estate a lot. So I try to pull some that pertain to realtors. So for an accounting platform, QuickBooks is by far one of the most popular and simplest platforms to use. If you want to do a free route, you can of course do a spreadsheet like Excel or Google. That's another way to do it. QuickBooks is not that expensive. I'll give an intro of the pricing on it, but that would be probably preferred because it is a lot easier. Expense trackers, you've got apps like Expensify, Zoho, Hurdler for real estate agents. Bill pay, try to avoid Venmo. I know a lot of people do Venmo, but again, if you have a business entity, it's better just to do it through bill pay because you're going to have to do 1099s. So if you guys pay photographers or if you pay people for advertising the properties, you have to give them 1099s if you pay them $600 or more in a calendar year. So just finding ways you can better track those expenses. Mileage trackers, you got Stride Tax, MileIQ, TripLog, Tax Mileage, cloud storage filing systems. I know hopefully a lot of people have gone more web-based rather than paper, but we use Dropbox a ton. Google Drive is another big one, but being able to organize maybe by year, however you guys keep things organized, but it's just easier to have everything at your fingertips and access on your phone as opposed to going through filing cabinets. Project management app, Trello, we use Trello quite a bit. And it just is like a checklist you can do for yourself every single day. Or throughout the week of things that you need to check off and complete. It's just a way to keep you organized. And then lastly, a scanner app. I added this one personally because I use it all the time. Has anyone ever heard of Cam Scanner? It's like the best thing ever. You can take your phone, take a photo of, whatever documents you have, and then email it to yourself in a PDF. It's a really quick little app that we use all the time. It might be helpful. All right, time management, as far as how are you going to keep your finances organized? Obviously doing it yourself. It's great for brand new realtors. It's free, it's just your time, but then time is money. So if you're better off out there marketing and networking to sell another house and get a bit bigger commission check, maybe you can delegate it to one of your employees or an office manager. Otherwise, consider outsourcing to an accounting professional. Again, that is because it takes that time away that you would be doing non-revenue generating admin work when you could be out there going to another networking session. And you're also hiring someone that knows how to get the most tax deductions for you to save you money in the long run. So it's just something to think about. These are just a couple reasons why you should manage your finances and keeping them clean and accurate. You're able to track key performance measurements like cash flow, profit and loss, net worth. Again, as you're growing and you've been in this industry for a long time, these are really powerful reports to see year after year. Also, if you have rental properties, analyzing which rental properties perform the best. We've had clients where they have, and I'll go into this a little more, where they have 5 rental properties and they take it all together, mush it into one bank account, mush it into one financial report. And I'll ask them, well, how do you know if this property is doing well or if this property is carrying the other property? And they say they literally have no idea. So one could literally be losing a lot of money and the other 4 could be carrying that one. So why would you even hold on to that one? So what we did is we went back and we separated every one of those, the revenue, the expenses per property, and lo and behold, one of them was tanking. So year after year. So it's like, why even hold on to that? Sell it off and go get one that's going to make you money. But he would have never known that if we didn't go in and separate the financials correctly so he can see that. Obviously, it's going to save you money with a tax prep because your CPA won't bill you to organize it. And then of course, if you're trying to get a loan or line of credit with a bank, they're going to require up-to-date financials. These are a couple due dates. Obviously, you know, 4/15 is coming up right around the corner. Hopefully you guys are all prepped up for your tax deadlines. Don't forget about your quarterlies. That's also coming up on April 15th. And if you have an actual business entity, you've got your annual report coming up April 1st. You got your business tax coming up April 15th as well, and Schedule B, that was due a couple days ago. And then those 3 are only if you have an LLC or an S corp. But the top 2 you have to do no matter what. Okay, meals and tax deductions for realtors. So I don't know if you guys recall in 21 and 22, so last year, your food and beverages, so your meals, they're actually 100% tax deductible if you purchase from a restaurant for those 2 years. So that was a perk that we didn't get in the past, but in 2023, so this year, it went back down to the regular rate of 50% deductible. So if you're doing your financials for last year, you still can write off 100% of the food and beverages you incurred for business related activities. All right, these are some other typical tax deductions for realtors. Again, if you're running this through your personal accounts, these are things you can weed out and put on your business financials as write-offs. So you've got your advertising and marketing expenses. So anything from websites, flyers, mailer cards, photographers, you can separate out and take advantage of that. Professional fees, so if you are paying a CPA or an accountant or have any legal work done. Continuing education, I know you guys have to do that. That is all a write-off. Any books or any, sometimes you can get away with shows if you're watching shows too about real estate or subscriptions. You might be able to write some of that stuff off. Business travel. So how business travel works, you can either write off mileage or you can write off gas. You cannot do both. So you guys would probably get a lot more bang for your buck for a deduction with mileage, but it is more time consuming to track. So for 2023, we're looking at 65.5 cents per mile. Otherwise, the more simpler way, but you won't get the biggest bang for your buck, is go ahead and charge the gas pump with your business credit card. So it's either or, you cannot do both. Dues and subscriptions, any software, any like even your Apple iCloud storage or things like that that you need to have to operate a business that touches your business. You can go ahead and write that off. Now your home office and office supplies, all your office supplies can be written off, but your home office will go in your personal tax return. And that's based off the square footage of the space that you're using in your house. If you do any charitable contributions, and then of course, if you or paying others like an assistant or other assistant realtors to help you their commission or contract work that you pay out. So yeah, of course.
The charitable deduction, charitable contributions of money in personal or out of business.
You can run it off from your business account. Absolutely.
Either one.
Yeah, absolutely. Yep. And again, yeah, go ahead.
I see cell phone, like, can you run off your, like, a part of your internet expense around?
Mm-hmm. Absolutely. Yep. So there's a lot of little things you can take advantage of to write off. But again, my biggest takeaway for you guys, if you haven't done so already, get a separate bank account, get a separate credit card, keep it 100% separated. And since you're early in 2023, go back to January and February, weed those out and put them on the financials. That way you have a full year and you can start off as a 2023 moving forward. Yeah.
When you open that business checking account, is it fine just to go like fund it in your personal, or can I put 5,000 in here, get me started from a business credit card?
You got it. Yeah. So that's just called an owner's contribution. That does not hit the profit and loss. That's not going to be recognized as income. That lives on the balance sheet in the equity section. So anytime you infuse money or take money out of the business, that's personal money, that does not impact your profit and loss. And your taxes are based off of your profit and loss. Yep. Good question. All right. Retirement. This is another big deal. So as realtors, you work for yourself and you don't get to take advantage of corporate 401ks and pension plans and things like that. So if possible, even a little bit, go ahead and open up some sort of retirement plan, some sort of retirement contribution for yourself to help yourself in the future when you do retire. So these are just 4 common ones. You got Roth IRA, which is one of the most popular ones if you're just yourself. Company simple IRA. So if you've got a team and you've got an entity that you've already created, a simple IRA is a really good option that you can participate in and your employees can participate in, and it's tax, the employer contribution is tax deductible as well. You got a SEP IRA and then of course a solo 401k. So what I would suggest is hire a financial planner. A lot of times you're not paying them a fee, they're just taking a fee off the top. So it's not like an expense coming right out of your account, but it's something to set yourself up for a healthy retirement when you do retire from real estate. Again, if this is like your full-time gig and your full-time passion that you're in, just a suggestion, even at a small scale, put away something towards your retirement and let it do its compound growth. All right, real estate investing. So taking advantage of owning rental property. So as you're growing, you're like, oh, do I want to put in the stock market or do I want to buy rental property? So the tax advantages of owning a rental property, you get the expense of interest and depreciation. You got your property tax, of course, any repairs and maintenance have to do with it, advertising the property, insurance, and then driving to and from the property. Those are all write-offs that you can expense out if you own a rental property. And then how is rental property income taxed? So in short, it's taxed as ordinary income. So if you're in example, if you're in the 22% marginal tax bracket and you have 5,000 rental income to report, you'll pay $1,100. So it is ordinary income, but you can take the top portion and lessen the tax burden with the expenses that I mentioned above. Real estate investing and accounting. So as I mentioned before, my example, if you do get into purchasing rental properties, if you start out with just 1 or 2 rental properties, I personally suggest going to get a separate bank account for each. Now, again, this is literally bank account A, bank account B, bank account C, and you can literally nickname the bank accounts per rental property. So for example, I personally have a few rental properties. Each one of mine, the bank account, when I log in, I see the street address. So all the money coming in hits the particular bank account. Anytime I have an expense, I use the card associated with that bank and put the expenses there. That way, when it's time for my taxes, every CPA is gonna want you to separate the rental properties per address. Yes.
Do you have each, so you have multiple investments, do you keep each of them in a separate LLC?
Great question. I personally do not. I have an umbrella policy that covers, I got a higher umbrella policy that covers, you know, what I would imagine would be a liability if something happened. Now, we do have clients that separate each one out into its own LLC because they're in the game of real estate. So their exposure is, so when you have an LLC and you buy the property under the LLC, if someone's going to sue you under that, it's going to be a localized liability, meaning that if somebody gets hurt or whatever happens in that rental property, it's not going to affect the other LLCs, if that makes sense. That's the beauty of an LLC. They can't go after your personal assets or the other LLCs. So that's why you would do it that way. You could do either or. There's pros and cons to both. The liability is great by separating it, but then you also have franchise and excise fee, the annual reports. There's a lot different tax returns for each LLC. That's personally why I didn't do it, but to each their own. And then if you, the middle portion is, if you're in the real estate game and you have a lot of rental properties, it wouldn't make sense to have 40 bank accounts for 40 rentals. At that point, you'd have probably somebody in-house doing your accounting, and you'd be what's called classing each transaction per property. And then lastly, if you have multifamily properties, so if you buy a unit with say 20 or a building with 20 units in it, and it's made up of 5 fourplexes, let's say, spread across town, you only need 5 accounts because each building is considered one, not the units within it, if that makes sense. And I'm talking from a tax perspective. All right, so if you're like, okay, I am ready, I've been operating under my name and I want to actually create something that's a little bit more formal, there's 3 different options. There's a sole prop, an LLC, which is single member or multi-member, if you have a partner, or you have corporations. So in a nutshell, here's just a little visual. The biggest differentiator is an LLC and an S corp protects you from your personal liabilities, where a sole prop does not. You get more tax advantages with the formal entities. You are responsible for paying self-employment tax for either 3 of them. And this admin and setup difficulties, oh, what just happened? Ta-da. Okay. So the setup difficulty is not that hard to do on either of them. Now, an S corp gets a little bit more because you get into stock options, but in a nutshell, a sole prop is very, very easy and low cost to get up and going. You operate under your social security number. However, you can get an EIN number with the IRS, which is essentially, call it like a social security number for your business. A lot of people do that if you have to, if you have payroll. You can operate as a sole prop and have payroll by getting an EIN number. Very easy record keeping, cheap. You don't have to file annual reports with the state. You don't have franchise and excise tax. So sole prop is very simple, but you're not getting the additional tax advantages. And really the biggest thing, it's exposing your personal liability. That's really the biggest differentiator. I'm not going to go through the full, every single line item, but as I mentioned, those are kind of the biggest takeaways. And the disadvantage is obviously the exposure to lawsuits. It hits your the personal side. Now, the difference between a corporation and an LLC, you're a member. If you're an owner, you're a member of the LLC. A corporation, you're considered an owner of the company. Now, for payroll purposes, if you're a member of an LLC, you cannot get paid as an employee. So what you do is you take draws. So if you're building all this money and you want to take money out of the company to live life or pay personal expenses, you're simply transferring money from the business account to your personal account, and that's called an owner's draw or a member draw where you're transferring money, no taxes are taken out. So you need to be saving for taxes. Okay, and that, remember, anytime you take money out of the company, it's not impacting your profit and loss. So you're not getting a write-off for it, okay? Then you have a corporation, majority sets up, you set up it as an S Corp. As an S Corp, you can be an employee of the company. So what that means is you can set up a formal payroll and you can pay yourself out as an employee. So with a payroll expense, that is a business expense and that does live on the profit and loss. Now, the caveat to that is if you're paying yourself, you're also paying Social Security and Medicare and SUI taxes on your own wages. Does that make sense? So if you're making a lot of money, it's not a bad way to have additional expenses on the books. You're saving for Social Security on yourself in the future, but you're also paying payroll employer taxes on yourself. So remember, FICA is Social Security and Medicare. Employees pay it, but so do employers. They match it. So you're paying it on your own wages, if that makes sense. So a lot of times what people do is they do a 60-40 rule. They'll pay themselves out 60% via payroll to get those expenses on the profit and loss, and then take a distribution for the other 40%. That's kind of a little loophole as far as paying yourself out in a strategic tax manner. Yep.
So like, would you, like, is there a number or range in your mind where, you know, hey, if you gross more than X amount per year, I would suggest a corporation versus an LLC for tax purposes?
Sure. It has to also do with your overall tax picture from your entire family. Like I don't know if you have a family or if your significant other brings in income, if you have kids, all of that plays into the whole tax. So it would be one of those things where I would recommend going to your CPA and talking about it with them, because there's so much strategy involved in it, and there's so many elements involved. So what I'm trying to do is just kind of give you the differentiators. I would say 90% of people set up LLCs, majority do it that way. It's just easier. Single that you do just owner's draw anytime that you want to take money out, but you do have to save for taxes. Again, there are different advantages of corporations. They're a little bit more complex, but I would say about, as in our book of business, about 10% are S, maybe even less are S corps. Yeah. All right. So again, without going into all the nitty gritty, by creating an LLC or a corporation, you are shielding yourself from personal exposure. So if someone was to go after you, they cannot touch your personal assets. Now they can take out everything in your business, but they can't touch your personal assets. So that is why people set up LLCs and corporations. We've got quite a bit of realtors that we do financials for, and they're making, you know, X amount of money where it made sense for them to set up a formal entity, or they're maybe looking to hire somebody. There's a lot more exposure when you get into those different elements and have employees involved. That's when I'd highly recommend having a formal entity like an LLC or an S corp. Does that make sense? So sole props are awesome. They're great to get up and going and started. When you have different elements coming into play, when you have rental properties, employees, you're growing, and maybe you have a team under you, that's when you would want to consider having a formal entity like an LLC or S corp. All right, how to set up a new business? In a nutshell, you want to make sure that your business name that you want to call yourself is available on the Tennessee Secretary of State website. So if you want to call yourself Nashville's Best Realtor LLC, you got to go see if it's available. If it is, then you would simply apply for your LLC, which is Articles of Organization, with the Tennessee Secretary of State. And you'd also want to go to the IRS website and apply for your EIN number. And with the Tennessee Department of Revenue, you've got a business tax and franchise and excise account that you'd be required to have if you have an LLC or corporation. And then of course your business license is tied to that. Okay, So now you've set up your company, you've set up your entity, and now we have, how are you going to manage this? So I've talked about this briefly. We've got QuickBooks. Sorry, it's formatted a little differently. That S is supposed to, I don't know. So again, why use it? You're ensuring that you're capturing all of your income and expenses, and you're doing that by reconciling. So I can't tell you how many times we've inherited financials, and I'll never forget this dentist client. He was so hell-bent that he was doing his financials correctly, and he's like, I'm reconciling, I'm doing this. And I'm like, all right, well, let me see it. He's never reconciled it. He thought reconciling meant just adding it, but there's an actual feature within QuickBooks where it makes you put in an ending balance, so the debits and credits zero down and match that ending balance. Lo and behold, there were glitches in QuickBooks where certain days didn't get downloaded. He was off $42,000 in expenses. If he did not hire us, he wouldn't have taken advantage of $42,000 in business expenses. So you can imagine the tax liability that we were able to help with, but that is also showing you the importance of utilizing a formal platform and doing reconciliations, because it's ensuring you're counting down to the penny, every single dollar coming in and out. And that also, of course, gives you accurate financials for you to look at and see how your business is actually doing. And then from there, there's so many different reports in there. You can look at your cash flow, your year-over-year growth, maybe pull like a trend 24 months and see where your highs and lows are, and be like, wow, I didn't realize that April and May are super slow for me every year after year after year. What can I do to boost business during those months? Or whatever that is for you. But, or you can be like, wow, I didn't realize I was spending so much in advertising. Like, am I getting a good ROI on this? Or whatever those expense buckets are, it's really powerful to have that data so you can actually see how your business is doing. Obviously the features, you've got your reconciliations, like I mentioned. You can create invoices in there if you need to for anybody. You can pay bills out of there, and you can process payroll out of there, even though I don't recommend their payroll feature, but you can do it. Okay, so I tried to do this just to keep it a little simple for you guys, but they do have 4 different packages. Simple Start is plenty, and it'll do everything you need it to just for basic books. So it's not that expensive, $30. It is a tax, right? It's a business tax deduction, $30 off of your expenses, but it's just smart. It's a good business practice to get up and going. It's not that complicated. But again, if you are going to do this, go back to January 2023 and start it from then. That way you have a full year of financials in there. And you'll thank me like 5 years from now, and you'll be like, wow, I've got 5 years of clean and accurate financials. Okay, balance sheet. I know financials can be a little intimidating to look at, but just to break it down a little bit, if you're a sole proprietor operating by yourself, a balance sheet essentially is literally what your balances are at that specific moment of time. So your assets are going to tell you your bank accounts, your inventory, your fixed assets. Those are going to be your rental properties that you have, that you own. And again, it's the balance at that specific date you pull the financials. Your liabilities are going to be credit cards, loans, mortgages, things like that. And then of course you have your shareholders equity, which is your personal, remember owner's draw when you mentioned that question, any money going in and out of the bank account. So let's say you accidentally charged your dog food on the business credit card. You wouldn't put that on the business profit and loss. That would get coded under the owner's draw, under the shareholders equity, because that doesn't impact your financials. Then you've got what everybody wants to look at is your profit and loss, which is your income less any cost of goods to operate it, which gives you your gross profit, less your operational expenses, and your bottom line hopefully will be a net income, not a net loss. So that when you're reading that, again, no personal money impacts your profit and loss. It's going to be any business related money you have earned, and then of course money going out, and then you're going to have your bottom line, and that's what you pay taxes All right, lastly, if you get to a point where you're like, man, I am working so hard, I don't have any more time in the day, I gotta hire. How am I gonna hire somebody and how should I hire them, or how should I classify them? So you have two different options. You have a W-2 employee and you have a 1099 contractor. A lot of people have been trying to get away with a 1099 contractor, so they're avoiding having to set up payroll. However, the IRS has discovered a lot of people in small businesses and businesses are doing that. So they're really cracking down on this. So when you think of what differentiates them, a W-2 employee is really somebody that you give them a schedule, you give them the laptop and the office equipment, office supplies. You might tell them like what apparel they have to wear. And they're your regular employee, you're their main source of income. And they use your company supplies, right? A contractor is somebody, it's just the total reverse. They get paid per project. Technically, they should invoice you. They set the price. They use their own office equipment. If they don't want to work that day, they don't have to because they might have other projects that they need to do. So I've heard a lot of people say like, well, I have an assistant, but she only works part-time for me, so I pay her as a contractor. Well, there's that fine line. You can get away with it for a little bit, but should that person really be a W-2 employee? And again, we've seen companies that got audits, and what happens is the IRS auditor will go back to when that person was first employed and tack on penalties and interest from the data hire of when they should have been an employee. And a lot of this happened during the pandemic when there was a lot of layoffs. These contractors would go to the Tennessee Department of Labor and want unemployment money, but they were never really employees. They were contractors. So that's where they discovered a lot of misclassified people working. Does that make sense? So there's a questionnaire. It's like 10 questions. If you answer yes to one of the 10 questions, then that person should be a W-2 employee. And if you have to have W-2 employees, hire a third-party payroll company. We do the same. Again, I'm in accounting. There's too many legislative changes to keep up with. One day of misfilings, they're going to tack on crazy penalties and interest. Just get like an ADP or Paychex or QuickBooks Online Payroll to do all the payroll tax filings, and it's all automated. Ta-da! I hope that wasn't too boring. What questions do you have for me?
And if anybody's out there in the Zoom land, you have any questions, just go on and put them in the chat and we'll feed them to Andrea.
Yes, so I can email you all this stuff after the fact, but if you want to shoot me over an email, I can send you all the information. Yeah, so no, the reason we don't have pricing available because every single client is so different from the next, and it's fully customized. So someone might hire us just for reconciliation. Someone might want us to process their payroll and pay their bills. Someone might have 3 bank accounts and the other person might have 1 bank account, but 5 credit cards, you know? So it's like fully customized based on your particular book of business. Yeah. But we don't, yeah, let's go ahead.
All right, and we have a question from, from Sylvia.
Yes.
From Zoom land. If we are doing health insurance via ADO, how does that work in our taxes?
If you're doing, so you can't expense your personal health insurance. That would go under owner's draw.
Okay.
Yeah.
An ADO staffing partner, she says. So you said.
So,
you
but if
cannot
it's,
expense.
but if it's employee, is that just for her or is it for her employees?
Sylvia, is that just for you or do you have employees? Just for her?
The no.
No. Sorry. But no, no, she said no what? You might want to restate it again, but no.
Oh, yeah,
you can't
so-
expense that.
So yeah, you can't, if it's just yourself and it's your health insurance, no, it's not a business expense. But if you have an employees and you're offering health insurance, then yes, you can. Yeah.
So even though if you set up an S corp, then you can be an employee?
Yeah.
Here. So in that situation?
In that situation, have her email me and I'll do some deeper digging into that. Did you have a question?
When funding a SEP account, still fund for last year up until what date? Was it April 15th or just whenever you filed?
I want to say it's April 15th. Yeah. That's awesome that you were saving for retirement.
The 15th is a Saturday this year, so it would.
So it'll bump up to the Monday.
The 17th.
Yeah.
Yeah. I like that early on when you were saying to outsource some of this stuff unless
Yeah.
you happen to be an expert at it
Yeah.
already. I like that you put that would be equivalent to you trying to sell your own house.
Truly, yes.
That's, I mean, we believe in the value of the services we provide.
Yeah.
And know that we're experts in certain things, so.
Well, it's literally like me asking, like, why should I hire you?
Yeah.
It's the same difference. It's like, you guys are experts at what you do. It'd be like me trying to be like, how should I advertise my house? How should I sell? What should I price it at? I'm not going to get the biggest bang for my buck if I try to sell my own house, get it out to as many people, but that's what you guys specialize in. So, and even like us, we're in accounting, and I've told you several different areas that we outsource, even though it's kind of in the wheelhouse of accounting. So if you're not great at it, if you're not an expert in it, if you can afford it, outsource it.
I also, when you were speaking about a good practice of taking a portion of each commission check and putting it into another separate account
Yes.
for your emergency fund or for taxes or for planning. Just to remind everyone here, Village will do that for you. You can designate separate accounts for portions of your commission check to go in. You tell them how much you sell where it goes, so they can help you with that just from, when they're paying you out.
And I'm sure you've got the feature where it can even be a percentage.
Yes.
So let's say like 10% automatically goes to account B, and the remainder will go into my main operating account A or whatever.
Absolutely. So
It's such a good business practice to do.
Yeah, so for Village folk, you can set that up with Susan Turner. Just reach out and she'll help you with that. Any other questions? Andrea, thank you so much.
You're welcome.
Thank you for your
Thanks for
service
having
and your
me.
expertise.
Yeah.
Andrea's contact information, let's see. Oh, yeah, there it is. Andrea at irisfinancialgroup.com. Please send her an email if you have any questions. And thank you all so much.
Yeah, thank you so much.